Bitcoin trades in a tight range as crypto vol collapses despite risk asset weakness. Skew for puts goes bid as investors remain nervous, but large call buyers come in Ethereum as they prepare for the merge. All this and more in this week's Crypto Insight. Okay, crypto this week. BTC's kind of established a short-term range. So it's been quite benign, right? Despite risk assets moving around a lot. If we look at the kind of short-term price action in Bitcoin. So we've been stuck in this 38 to 42 range, for the last week or two. Tried to threaten the exit on both sides, but didn't really manage it. So that seems to be the range that we've established in the short term. In terms of crypto-specific news drivers, you've had the launch of more algorithmic stable coins, okay? And that's what we had with Luna and Terra, right? And that was, they added a load of Bitcoin to their treasury, which provided a bit of a bid recently to Bitcoin. And that was what the catalyst was for that leg higher that we saw. So that's putting a bit of a floor under the market in Bitcoin potentially, if these guys need to, add Bitcoin to their treasury. And that may well be why we're not seeing as much of a sell-off in Bitcoin as we have seen in risk assets like S&P, basically, right? So something to be aware of that may be supporting prices in crypto in short term, at least. Obviously, the broad macro weakness and the risk asset correlation is still weighing on crypto, hence why we're not rallying. Higher yields, withdrawal of liquidity, these are all things that are going to impact higher beta risk assets, and Bitcoin is one of those, right? So these are things that are weighing on it. So you kind of got a bit of a tug of war between those sort of factors. But like I said, Bitcoin has held up relatively well compared to the recent slide in NASDAQ. So does that signal that we might start to see a bit of a breakdown in the correlation that has been quite high recently between Bitcoin and NASDAQ? And if so, then Bitcoin can start to do its own thing, right? So that's something we need to keep an eye on, that correlation, if that really does start to break down. But you can't really make that assessment in like just a week of price action, okay? Now, if we look at this chart here, I still favor the downside break. Why is that? We had that big impulsive move down November to sort of January. We now look like we're in a corrective sort of price action now. Nothing on this sort of move up since Jan looks impulsive to me. So I don't think it's the start of a new leg higher. I think we need a resolution to the downside. And, this kind of leg down from 48 down to 40, we are now consolidating that leg down. And once that consolidation is over, I suspect we then get our bigger move down to our ultimate target of wherever we're going, which I suspect will be somewhere between 25 and 30K when this final move's over and we see a lot of signals there. Then there's been enough of a liquidation to really get excited about the longer term prospects of this thing, right? But right now, I still favor the downside break, okay? Then if we look at over at Ethereum, similar sort of story, obviously getting dragged down by the market, but this sort of uptrend support around 2,800 held intraday yesterday. It also coincided with the fib retracement of this 62% fib retracement of that rally. So it was kind of a double support level that held on the first test. You've also got the Ethereum Bitcoin spread consolidating, but not really reversing. Broke that downtrend, had a nice leg higher. Looks like it's consolidating, and so it's still intact. No reason to believe that ETH can't still outperform to the upside, especially as it's got its catalyst potentially coming later in the year, right? We don't know when the hell it's going to happen, but the merge is supposedly Q3, Q4 type timing, and that's kind of making people want to own this stuff relative to Bitcoin, basically, right? You've also had a bit of an uptick in the trading volume of NFTs. Right. So if you look at the April data on NFTs, quite a big spike, kind of the biggest month this year by far in terms of NFT volume. So that's probably going to create a bit of an uptick in the fees on Ethereum. Therefore, they're going to burn more Ethereum. Therefore, net new issuance is going to drop and that sort of stuff. and that is generally supportive to prices for Ethereum, basically, right? So those are the kind of factors that play in Ethereum. Now, you know, I've been playing it through call switches because I wasn't ready to just go outright long a load of crypto beta because I'm not particularly bullish on risk assets. So I was like, how do I get exposure to a potential move up in Ethereum, but not lose any money if crypto overall sells off? So I was using call switches in April. They ended up expiring worthless, but they didn't cost me anything, so that's fine. I think now I would probably do the same trade, but do it out to a bit longer dated maturities, right? So going out to maybe September, even longer. So I think doing September call switches, long Ethereum calls, short Bitcoin calls makes sense. The vol spread out in September is still a little bit steep relative to the front end because front end's kind of compressed a lot, but you're paying, you know, you're paying that premium for a reason, right? If Ethereum catches a bid, it can outperform by 50%, right? So it's not, I don't think the premium you're paying for those call switches is that big a deal. You know, another okay way to get long Ethereum, if you've got that sort of medium-term bullish view, but you don't think that it's going to necessarily fly in the next 2 months. I put this on Twitter the other day, was you could buy June, December call calendars where you kind of own, 20 Delta calls in December. And then you sell some 10 or 15 Delta calls in June to get some premium back, basically, right? And the chances are we're not going to smash through 4,000 by June, but we could easily see 5,000 or above by December, basically, right? So you can get into that. It's like a call option that doesn't really decay much, provided we don't smash through your short strike in the next month or two, which I think is pretty unlikely, personally. Yeah. Okay, so those are my thoughts on Ethereum. If we then have a little look at on-chain metrics and what's going on there. My key takeaways from on-chain metrics this week, right? So you've got the perpetual futures funding rates and the cash and carry yields. So that's the longer term futures, right? They've been persistently low, right, for the last sort of 6 to 12 months, less than 3%. So because of that, that's motivating capital to leave the Bitcoin space because you've got higher yields now in TradFi and you've got the yields that were up for grabs in this stuff going down, right? So people are just sort of taking money out of the space and allocating it elsewhere, right? Because why are you going to allocate to this risky space or what is considered risky when you're not getting the excess yield anymore, basically, right? So that's one thing we're seeing in those sort of yields. Then you've got transactions above 10 million. They've maintained a share around 40% of transfer volume. Okay, so we saw an uptick in that sort of that transaction volume as the market started to accelerate and there was more institutional adoption, and then that's been maintained, right? So that's showing you that a lot of the activity going on is in those large $10 million plus clips. So the institutions are active and they are still playing in space, right? So that's the long-term sort of positive that you've got that institutional adoption and they haven't gone anywhere, basically, right? You still need to see more of that and you want to see more of that to drive the next leg higher, but it's just something to kind of keep an eye on. Then you've got various sort of implied valuation models, right? That people like Willy Woo, I believe, is like the big one who's kind of created this model based on transaction volume and that sort of thing, network adoption or whatever it is. And basically all I'm saying there is that they put Bitcoin's fair value right now at around 32 to 36K, right? Which is a good 10% below here. So it's kind of in the face of that, it's kind of like how much upside have we really got if their fair value for the guys who tend to be quite optimistic about Bitcoin in the way they model it and stuff, they're putting the fair value 10% lower, right? So that's something to kind of be aware of. And then short-term holder cost basis is around 47K. So that kind of acts as a bit of a resistance to the market, I would say, right? So unless we break that short-term holder cost basis level at around 47K, then we can really start to see some upside, right? Some real upside in this market. So I see that as a bit of a resistance area where if they get back to scratch, they might get the hell out, right? And you'll see some supply come back to the market if you get close to those levels, basically, right? So that's my main takeaways this week from the on-chain stuff. Okay. Now, if we move over to the volatility side of things, realized vol's pretty muted still. Like I said, we're very range bound. We're seeing an uptick in cross-asset volatility, in rates, in equities, and we're not really seeing that in crypto for whatever reason. Bitcoin 1 week realized at 45 and Ethereum's at around 50. The implied realized gap has been moving around, but right now it's sitting at around 10 vol points, which is quite steep. Okay, because the front end popped yesterday as the market looked like it was going to break down and then didn't break down. Okay, so I would say that, given that we're still in the range, I reckon implieds are probably going to come back down to be more in line with realized, unless we get an immediate break lower over the coming days. Okay, so unless we get this meltdown, then I would suspect vols are going to drift back down in the front end. Okay. And then over the last couple of weeks since I've been out, the Vega part of the curve has continued to soften. So whilst you've had the front end being quite choppy, moving up and down, every time the market looks like it might be breaking the range, the long end vols they're just drifting, right? They're just drifting lower because the market is really starting to price in structurally lower crypto vol, it seems, okay? Because we're getting more supply, right? As a market matures, as more participants enter, as more people hunt for yield and own the underlying asset, then you get more structural supply of vol, and that's kind of starting to really get priced in, and we're seeing those long end vols hit multi-year lows. Okay, so you had a few people out there saying that they think vols are buy, long end vols are buy. I don't think from a vol perspective it's necessarily a buy, right? I think if you want to take a directional view on a 6-month view, it's quite cheap to buy 6-month options to express that in crypto. But just from an outright vol perspective, I don't see a great reason to buy it, basically, right? Those are my thoughts. Because I don't think the implieds are going to gap higher without some real significant catalyst and without some significant sustainable volatility, basically, and I don't really see that at the minute. And this chart here kind of shows you, we had a very steep contango a couple of weeks ago. You can see that from the gaps between all these lines. And then you see that front end start to pop and you see those lines converge. That's just the term structure flattening. Then it collapses again. So you see that pink line and that blue line. Those are the 1 week and the 1 month vols. They pop, then they fall again. They popped again yesterday, and now they're on their way back down, right? So these pops in the front end of the curve are generally quite short-lived. And you can see that even looking at a 2-week chart of this stuff, okay? Like I said, I think medium-term calls offer reasonably good value if you are bullish, but it's the directional exposure that you're looking for. So you don't want to be delta hedging those. You want to be doing those naked, and we have started to see that type of flow in the market, yeah? We then look over at skew. Obviously, put skew continues to catch a bid with the general macro weakness. And the market kind of scratching its head as to why crypto isn't selling off harder. So they're buying puts in case it does. So both Ethereum and Bitcoin skew going bid. The 1 month maturity has actually been outperforming the 1 week maturity in that, if you're nervous about the market on the macro side of things, right? Are you going to buy a 1 week put on crypto when it's stuck in a range, or are you going to buy a 1 month put that gives you more time for the market to break lower, and it encapsulates the Fed meeting in May, which might be your catalyst, right? So these are why people are kind of buying puts in 1 month space rather than 1 week. Whereas historically, people wanted to use the super short dated options to get leverage to that crash. Well, the put skew is more bid now in the 1 month than it is in the 1 week, right? And that's the reason, basically, particularly for Ethereum. Okay, so that's kind of what I'm seeing in skew. And like I say, because of that extreme put skew now, that's what makes calls look relatively cheap, right? Is it? So if you are bullish, that's why you would be saying, okay, skews favorable, vols are low, call vols about as low as you're going to get it, basically, right? So it's not a bad time to buy those outrights. Now we've got decent volumes trading last sort of couple of days, particularly yesterday. It was a big day. In terms of the big flows that we kind of saw, we saw put buyers in April and May, kind of on the 38K and 34K strikes in Bitcoin. We had seen some kind of call calendar buying last week, selling the Mays to buy the Junes, similar to the trade that I described on Ethereum, but just keeping the maturities a bit closer. Now, after the pop in vol yesterday, we did see a May strangle seller come back in. That has been a bit of a theme over the last week or so, this May strangle selling, 38K, 44K strikes being sold there. And that kind of helped vol come off its lows and kind of drift back down a little bit, but it is still up sort of over the sort of last day or two. September upside was also active to get long exposure, some kind of call spreads and things like that further out of money being traded in Bitcoin there to get that. And then call volume generally dominant. So despite markets being a little bit weak overall, 65% of the flow was in calls in Bitcoin. So people are still kind of looking to the upside and ways to get exposure to that. Okay. If we then look at Ethereum flows, you know, the usual April strangle selling came from DOVs. DOV inventory obviously comes in, dealers get hit, and they hedge it out in the market. So the 2,700, 3,300 strikes are kind of where the big strikes are, particularly for Ribbon Finance in terms of their DOVs. So you see that in the flows there in the April. We saw some opportunistic buying of calls around the 3,400 strike in May, both early May and late May expiries. We saw September call ratios, 5,000, 10,000 call ratios trading in big size to get exposure to that upside in Q3, but without paying too much carry waiting for it, right? So, and saying that even if we do get a big rally in ETH, I mean, you know, you need to triple from here before you get to your sweet spot in that call ratio. The break even's miles away, right? So it feels like a fairly safe way to get your upside exposure in a way that carries quite well, basically. And then you had a higher conviction. That's not particularly a high conviction buy, but a higher conviction buyer was on screen buying, you know, 17,000 lots of the December 7,000 calls on Ethereum. They just left a resting bid there on the screen in size, and they got filled over some time, basically. And then the only last other flow to mention is some 1,000 and 2,000 strikes trading in December and March 23 expiries, which are, you know, I don't know for sure, but they're probably a buyer, right? Those are probably some deep downside protection, just in case, you know, this thing really takes a dump, right? Which you know, crypto potentially could do, right? So those are the big flows that have been going up in both Bitcoin and Ethereum, right? And then the last thing is Friction Labs. Friction Labs, who I mentioned before in terms of the DOVs, they have launched a new product called the Crab Strategy. So it's a new vault that they've launched called the Crab Strategy. And it's a yield harvesting trade, but you're not selling outright vanilla options anymore. What they're doing this time around is they're using perpetual futures and power perpetual futures. So for those who don't know what power perpetual futures are, they are a way of getting exposure to the square of the return. Okay, so that's why it's a power, right? It's the power of 2. And they're probably going to end up releasing power of 3 or whatever, I don't know, at some point. Okay, but anyway, this is the innovation that's going on in DeFi. So basically, power perpetuals, they give you convex exposure to the return of the asset, but there's a much higher funding rate for that convex exposure. So the idea is that to earn yield, you sell the power perpetual and you buy the regular perpetual and you earn a funding spread. And that funding spread that you earn, provided the market doesn't move dramatically, you get to keep. If the market moves, then you start to lose money, basically, right? So it's just an alternative way to get kind of a range-bound, theta earning. I don't think the market's going to do much exposure via this trade, basically, right? And that's what they've generated. And the kind of APYs that they're talking about are around sort of 30%, basically, you can do on this stuff. There's a couple of providers of this. Obviously, Friction have launched power perpetuals. There's this Squeeth product, which is a power perpetual on ETH. Friction's one is a Bitcoin one. So there's a few of these floating around. Apparently, you know, because of this convex nature of this product, for those of you who know what a variance swap is, it's kind of like a variance swap in TradFi, okay? And a variance swap is like a volatility product as well, similar to options, and therefore it has an implied volatility. And the idea is that the implied volatility in these products, in these power perps, is quite high relative to the implied volatility that you get in vanilla options. Okay, and there's a potential kind of arbitrage opportunity there, and that's why people find it interesting to do these power perp sales against regular perps. Okay, but that's what's going on right now, and so just something to be aware of. Like I say, Friction are the guys who've just launched this. There's your kind of payoff graph of what that looks like over 1 day, 7 day, and 28 days of this crab return. Check it out on their website if you want to know more details. I've also left a link to their Medium article describing the product in a bit more detail and stuff like that if you want more detail there. But yeah, that's kind of it for me for this week. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.